Hey, good morning. Let's go over to today's trade plan. So in the overnight session, we saw that responsive buyers were active above the previous day's VPOC and close, and we saw a pretty decent sized bounce in the market all the way up to the 68.75 overnight resistance where sellers were active. At this point, heading into the open, we know that the larger time frame bias remains bearish, but on the smaller time frames, we would have to see a break below the 58 to 60 micro bull bear zone in order to confirm the sell side back in control. Below 58, the primary support area is 48 to 50 half, and that's still an area where responsive buyers can be active, but just keep in mind that the larger time frame bias right now is bearish, and holding below 58 to 60 would mean that even the smaller time frame bias is bearish, so we do have to be careful now on long setups. It doesn't mean that you can't take long setups as a day trader, but now you do want to play more defense on the long side, and you have to be more aware of the trade location that you're getting on your longs. If you're buying at a very aggressive price, then it is a risky setup on the long side right now because sellers can step in at pretty much any resistance area on the way back up. So first test of 48 to 50 half can still attract responsive buyers, especially if we're not seeing any broad market selling across the Russell and Nasdaq, and the AD is still holding up fairly well. But if we're seeing continued weakness on the advanced decline and the other markets are breaking below their recent lows, then most likely ES will also break below 48 to 50 half. Now on the downside, below yesterday's low and below the initial support zone, the next primary inflection point is going to be at 37.75 to 39.75. That's still going to be a higher risk area to fade the market. Now, we can still get a rotation if the market is short-term exhausted into the 37.75 to 39.75, but otherwise, if you've already balanced ahead of it, you want to avoid that zone. On the downside, the major inflection points are really the 30 quarter to 32 quarter zone and the 23 to 26. Those are the larger time frame support areas, and those are spots where we can get some pretty decent responsive buying on first test and get a pretty decent bounce on first test. So those are zones where long setups can be considered, and especially if the market is exhausted into it, because those zones do provide very good trade location even on the larger time frames. But right now, the main question that we're going to be answering is whether the weakness and the big sell-off that we saw yesterday is still intact. Is that market structure still intact, or are we simply just back in balance and now the market can go back up? So we will keep an eye on the NYC tick to gauge momentum, because if we are going to head back up in any significant way, we will have to see some very strong upside momentum in order to do that, and some strength across the board in the Nasdaq and the Russell. But the way the picture is shaping up right now, looking at those other markets and just looking at the overall market structure, this is still overall a more bearish bias in the market, and for that reason, we are still going to keep our focus on short side, especially at the key resistance areas. Now, right off the open on the upside, we do have resistance at 67 quarter and 68.75 to 70.75. That is also the overnight high, so that area requires a little bit of caution, just because if we continue balancing up here and then start going up there on high momentum, we could break through and test the 72.75 level and the 74.75 to 76.75 initial resistance zone. The sell side can still be active at initial resistance, and it's still a spot where the market can fail. And beyond that, of course, we'll have resistance at 81 to 83 near yesterday's high. Now, in order to really break out above the initial resistance zone, again, we are going to have to see a lot of strength in the underlying internals, some strong upside momentum, and continuation and buying in the other markets. If that is absent in the other markets and we're not really seeing any major strength, then the bigger picture structure still supports the short setups, and the market can quite easily just fail right up here, even ahead of pre-market resistance, and just go right back down to 48 to 50 half, and then even break that zone. That is the first major support area on the day time frame, but it's not a zone that absolutely has to hold. If we get continuation and selling across the board, and we're seeing some continued weakness, then it's going to be very tough for the market to hold here. Typically, these types of big shifts in bias don't resolve within one day. Usually, even if the market is going to reverse and go back up, it'll usually take about 2 or 3 days of balancing and consolidation before we actually get that reversal. And for that reason, we want to be very careful on long setups today. And if the sell side is really going to press, then we definitely want to see a break below 58 to 60. So that micro bull bear zone is not really being used to establish our overall bias. Keep in mind that's simply used off the open to determine just the short-term bias to see are the sellers stepping in or not. Above 58 to 60 doesn't mean that the market is very bullish. It just means that short term we're not getting that larger time frame bearish bias to play out, and that might require the market to go higher in order to find those sellers. But ideally, ES actually holds below 68.75 to 70.75, and from there, there's potential for a breakdown below 58 to 60. So we'll just have to keep that reference area in mind, the 58 to 60, to establish our day time frame bias. And then even below that, we'll have to monitor 48 to 50 half and see kind of how the market's approaching it. We are running on above average volume, which means higher intraday volatility and potential for a wider range on the day time frame too, similar to yesterday. So, there are going to be a lot of setups probably on both sides, but given the larger time frame bearish bias, we are going to be more active and more aggressive on the short side and be more conservative on the long side. And if you are taking any long setups, just make sure that the market is short-term exhausted into a key support area, and then even if you're taking that, play defense with it. Don't give it too much time, and just don't let it balance for too long. If the market's balancing at a support zone and the underlying internals are getting worse and the other markets are continuing to go lower, then that simply may be a pause point for the market before we head even lower. So just keep that idea in mind too. So right now, the market's running on high volume, high volatility, news-driven moves too. So there's a little bit of added risk, but there's also added opportunity. Anytime you get a spike in volatility for day traders, that's a very good time to be more aggressive and more active in the market, because even if you have to take a couple of losses to get on board a big move, with the expanded volatility, the reward potential is so much higher that as long as you have the right mindset and you continue trading in a disciplined way and taking the next trade, not getting afraid and then skipping it, you can make those losses back very, very quickly. So this is the time to be a little bit more aggressive, but at the right spots, right? Not just kind of in the middle of range, with the right setups at the right spots. So those are the main ideas heading into the open. Let's see how the market reacts at 58 to 60. That'll set the tone for the day. And from there, let's just see what type of strength or weakness we see in the market. That'll help us gauge whether it's likely to be a more balanced day or we can get continuation. And we'll take it from there.